JP Morgan says retail traders are struggling. The average retail investor is up just 3.7% year to date, despite the historic market rally, according to JP Morgan data. So by comparison, the S&P is up by 25% and is on track for its best election year in 88 years. This marks retail's worst annual performance for any year where the index saw double-digit gains since 2015. Bad timing during market pullbacks has cost retail investors the vast majority of potential gains. This year, retail investors are on track for their fourth straight year of underperformance versus the S&P 500. So this is a pretty juicy tweet that came out yesterday, and I felt it would be a really good time to publish a video discussing why this possibly is, the major mistakes that retail investors make that ultimately cause them to underperform, and just highlight some massive pitfalls that many investors make. So let's dive right into the video. So everybody, before I start, this is the final day of our early access for Stocktrades Premium. We're offering a huge discount for those to get in on a Black Friday deal. There is a 30-day subscription back guarantee on the platform, so you can try it. You can see my portfolio, my returns, all my research, our stock screener. You can hop in on the Discord, ask me some questions over on our Q&A, all that type of stuff. Try it risk-free for 30 days. If you don't like it, you just shoot me an email and I'll refund you in full. That's how confident I am that this platform is going to help you become a better investor. But let's dive right into the video. So in a year in which the S&P 500 is up 25%, it seems pretty absurd to me that investors would be, on average, retail investors up 3.7%. That means that a huge chunk of investors are actually performing worse than this. And there is, this isn't a guarantee. I don't exactly know why this is, but there is a few reasons why retail investors typically underperform, and I'm going to try to go through all of them as briefly but concisely as I can in this video. And the number one reason that I do believe retail investors underperform relative to the index is they are absolutely obsessed with timing the market. They're always trying to buy stocks on sale. They're not necessarily buying companies that are doing well. They're instead buying lackluster, subpar companies that are trading at more attractive valuations, but are trading at those valuations because of poor operational results. I can think of one in Canada right now being BCE. A lot of investors bought this company all the way down to its current bottom. They thought the price, relative to what it traded at prior, the $72 a share, they thought it was almost immediately a good buy in the, mid to high $40 range. And now we're sitting at sub $40 a share. The company has declining free cash flow. They have declining revenue. They've suspended their dividend growth. Yet a lot of retail investors, this is probably just a mentality a lot of us have. We always want things on sale. We don't want to be buying stocks that are trading at highs. We instead want to, deploy that, Warren Buffett value type strategy. We want to be buying low, selling high. But ultimately, if price action is one of the main theses for your investment, you're going to get in a lot of trouble. You're going to make a lot of mistakes, and there's almost no doubt you're going to underperform. And the same thing can be said on the way up. If you're buying stocks that are too expensive, you will likely pay the price over the long term and achieve lackluster returns. Stocks can trade at 40, 50, 60 times sales, 100, 120 times earnings for very brief periods of time, but there is almost always a significant correction in terms of the share price over the long term. Things tend to always revert to the mean, and if you end up paying too much for equities, ultimately the higher price you pay for those earnings right now, the lower your future expected returns will be. This is something that has been known in the markets for a very long time. So price action likely comes in a bit too much with an investment thesis, much more than it should. Companies are generally valued based on their forward earnings growth, and past price action has very, very little to do with how attractive a stock is. So the second reason I believe investors likely underperform is something we call sunk cost fallacy. So effectively, sunk cost fallacy is your need to continue believing in an investment or possibly even dumping more money into an investment because of the losses you're currently sitting on and just the fact that you cannot accept that it might not be that promising of an investment moving forward. Ultimately, the only thing that matters with your money is where it is best placed moving forward. The idea that you're down 30 to 40 to 50% or whatever it may be on an individual equity or an ETF or an index fund, whatever it may be, that does not matter. Investors kind of have this mental, psychological block that they don't want to sell a stock, an ETF, anything at a loss. They can't stand the fact that they're going to take a loss on it, so they ultimately end up holding that investment, even though they might understand that it might not be the best thing moving forward for their money. They'll continue to hold it because they simply cannot stand selling in the red. And again, as soon as you adopt the mentality that the only thing that matters, except when we're thinking of tax perspectives, I mean, that can ultimately change things, capital losses, capital gains. But on the surface, the only thing that truly matters is where the money is best placed moving forward. If you invest $10,000 in an investment, it loses 50%. You can't have the mentality that you need to make back that $5,000 or, the investment isn't a success. Obviously, you're down 50%. The investment is already not a success. What you need to think about is that $5,000 you have remaining, where is that best placed? If you've lost faith in your current investment, there is absolutely nothing wrong with cutting ties. I do it all the time. I cut stocks when the thesis changes. I cut stocks immediately when I sense the money could be better placed anywhere else. I let it go. I've faced plenty of losses in my investing career, and ultimately this has led me to actually achieve higher returns rather than holding losers or dollar cost averaging down on losers over the long term, especially when the overall investment thesis has changed. Now, obviously, it is never a guarantee that the future investment you buy is going to perform better than the one you sell, but we're talking about probabilities here in the stock market. We can tell with thorough analysis what a higher quality company is than a lower quality company. So for example, if you have that stock that's down 50% and returns, theoretically 6% moving forward, an investment in a company that will return 8% moving forward, that will get you back to break even faster than holding the weaker equity. Again, it's all about where the money is best placed moving forward. So yes, you've had to book that loss, you've had to give up on that stock, but ultimately, if you have done your analysis, you've done your research, and you believe that stock or that ETF, that index fund is going to return more moving forward than the current holding you have, you can book that loss and you will ultimately be better off for it. Sunk cost fallacy absolutely kills investing gains. And again, if you can get over that psychological barrier of not, being able to accept the fact you're booking a loss, it becomes a lot easier. So the third main reason I believe retail investors underperform when it comes to individual equities, ETFs, things like that, is they truly don't understand why they own the company they do. This comes in more into play with individual stocks, but ultimately, whenever you are buying an individual equity, you need to sit down and figure out why you've bought that equity. You need a comprehensive investment thesis, and no, simply saying this company isn't going anywhere is not a solid investment thesis. Simply saying, I believe the stock is going to go up in the future is not a solid investment thesis. You need a core reason for holding, and this does tie a bit back into the sunk cost fallacy aspect of it. A lot of people who are holding these weaker equities, they're doing so because they really don't know why they bought in the first place. And again, they might know why they bought in terms of, I think the stock price will go up, but they didn't really do a comprehensive, in-depth investment thesis. And ultimately, if you do this, even if it's a simple napkin thesis, you need to know the reasons why you bought the company, because ultimately that will drive your decisions moving forward. And it's fairly easy to come up with the decision to sell an equity if you have a in-depth investment thesis as to why you bought in the first place. The reason why it's easy, you know why you bought, and if that that changes, you ultimately sell and move on to another opportunity. A lot of people make very, very basic decisions when it comes to their investments. They buy because the dividend yield is high. They buy because it's at a 52-week low. They buy because it's at a 52-week high. Ultimately, these just are very basic theses that ultimately when a stock gets into trouble or a stock has gone up a lot, you're going to be sitting there thinking, what do I do now? If you have a solid investment thesis, you will never be thinking, what do I do now? You will ultimately know what you need to do because you've performed thorough, comprehensive research, and ultimately that will drive your decision, not simple price action. Another reason I believe retail investors underperform is we generally follow a thought of, what have you done for me lately? And this is backed by actual historical data. So back in the 1970s, the average holding period for an equity was over 5 years, and in 2023, 2024, it's down to under 10 months. There is absolutely no way you could ever, if you had a thorough investment thesis, you could ever realize it in a 10-month time period. The market is absolutely unpredictable, the direction of which it will go over that time frame. Yet so many people just cannot sit on their hands and do nothing. They have to be acting. They have to be selling all the time. They have to be buying all the time. They have to be selling all the time. They're wasting their time on technical indicators, technical charts, which ultimately most retail investors have absolutely no idea how to analyze with any sort of accuracy. They're making short-term decisions that ultimately, cause them to underperform. There's a pretty common saying in the investment world, your investment portfolio is like a bar of soap. The more you play with it, the smaller it gets. And this is absolutely accurate. And I see it all the time dealing with thousands of retail investors. There's a constant need to tweak. There's a constant need to sell stocks based on technical indicators, which in my opinion are just self-fulfilling prophecies. There's a constant need for investors to make long-term investment decisions based on short-term technical indicators or short-term price movements. And ultimately, this is also a result of brokerage firms marketing. Ultimately, these brokerage firms make more money the more you trade. So they're going to encourage you to trade. It's become ridiculously easy to buy and sell stocks. I would imagine in the 70s, if you could buy and sell stocks as quickly as we can these days, you would, the holding period would likely be a lot shorter than 5 years because it's just that psychological element. We always need to be making decisions. We can't simply buy with a core investment thesis and sit on our hands. We're always second guessing ourselves, and ultimately that is going to kill our returns over the long term. And the final reason why I believe retail investors underperform is absolute information overload. There is so much information available online today, whether it be through some of our major competitors. I can think off the top of my head, Seeking Alpha, Motley Fool. They're constantly posting articles on specific stocks. They're from individual contributors. They're not, for the most part, they're not from the company themselves. So there is a wide variety of opinions. Some people can think a stock is a slam dunk buy. The others can think it's an absolute sell. We go down the rabbit hole of obsessing with this information. We read all these articles. We're constantly fed different types of information. One person believes a stock is overvalued. The other one thinks it's an absolute bargain. And we end up just, again, it's that bar of soap theory. We end up making way too many moves with our portfolio that ultimately lead to a lack of performance. There is over a century worth of data that suggests that buying strong equities and holding them over the long term, or an ETF, an index fund, things like that, has generated strong investment returns. But many investors cannot get it through their head that they need to do this. They constantly tweak, they constantly obsess, they're constantly fine-tuning, they're constantly reading all these articles that say, the utility market's going to boom in the next year. AI stocks, they're overvalued. You should sell them now. And then they read another article that says interest rates are going to remain steady. Utilities aren't a buy right now. And it feeds into the narrative that you always need to be making moves, when in reality, all you need to do is come up with a strong investment thesis for whatever equity you buy or whatever index fund you buy buy whatever, ETF you buy, you need to come up with a thesis as to why you own, and you simply do not sell unless that thesis changes. Overall, everybody, a little bit of a different video this week, but I felt I had to go over that tweet because it's stirring up a lot of attention right now. Let me know how much your portfolio is up in the description below. I'd love to see, the returns of readers, of subscribers, and remember to like the video, subscribe to the channel, and remember that Black Friday offer that we're going to be ending tonight. You can grab Stocktrades Premium in the description below with a 30-day subscription back guarantee, and I'll see you next time for more great Canadian content.